This video is for educational purposes only and is not financial advice. Hi, I'm John from Nordic Value Investor, where we focus on long-term value investing and company analysis. This is part 2 in a 3-part value investing analysis of Novo Nordisk, and in this part we'll look at the balance sheet and key valuation ratios. First, we'll look at debt to equity. Debt to equity shows us how much debt a company uses compared to its own equity to finance the business. It shows the company's financial leverage. A higher debt to equity means the company relies more on borrowing, while a lower debt to equity means it relies more on its own equity. Debt to equity tells us that for every dollar of equity in the company, how much debt does the company have. For this, I just went to seekingalpha.com, searched for Novo Nordisk, and went to their balance sheet. And down in supplemental items, Seekin Alpha has calculated the total debt for us. Total debt for December 2024 is reported as 102,787 million. And in the balance sheet, you also look for stockholders' equity, which amounts to 143,486 million. Then we divide debt by equity, and that gives us 0.7. This means that for every $1 of equity in the company has 70 cents of debt. If you want to be conservative, a debt to equity at 0.5 or less is recommended, but in the pharmaceutical industry, a debt to equity between 0.5 and 1 is normal. Moving on to the current ratio. The current ratio measures a company's ability to pay its short-term bills due within 12 months using its short-term assets. It answers the question, can the company cover its upcoming obligations with the assets it already has on hand? It's very easy to calculate. You look at the balance sheet and you take the current assets and divide it by current liabilities. We take 160,897 million and divide it by 217,528 million, and that gives us a current ratio of 0.7. This means that for every $1 of current liabilities, the company has 70 cents of current assets. A higher current ratio is therefore better than a lower current ratio. A number above 1 shows that the company has more current assets than liabilities on its books, while a number below 1 shows that the company has more short-term liabilities than assets. Generally, we would want the current ratio to be about 1.5 or above, so that the company has enough liquidity to cover its short-term bills. The lower the current ratio is, the higher the risk is. Therefore, in general, we don't want to see a current ratio below 1, but context does matter. When looking at the pharmaceutical industry, it's not uncommon to see a number between 0.8 and 1.2. Having a current ratio below 1 is not necessarily dangerous if 1. The company has strong operating cash flow, which Novo Nordisk does. 2. If it can easily roll over short-term debt and pay bills from ongoing earnings. And 3. The company has excellent credit ratings, giving the company access to cheap financing if needed. So while low current ratio can be a weakness for companies with weak earnings and balance sheet, it's not uncommon for strong cash generating companies to have a current ratio below 1. Next up, we're gonna be looking at Novo Nordisk's PE ratio. The PE ratio is a valuation metric that compares a company's share price to its earnings. It's a fast way of determining if a stock is cheap or expensive. You take the stock price for Novo Nordisk right now and divide it by earnings per share. For this, I'm going to quickfs.net, search for Novo Nordisk, and we're gonna go down in the bottom of the income statement and find EPS diluted, earnings per share diluted. We're gonna choose TTM, which means trailing 12 months. It's the most recent number. In Danish krone, we get 23 kroner and 33 cents. And the share price as of now, while I'm doing this, is 314 kroner. That gives us a PE ratio of 13.5. A PE ratio of 13 is very low. If we compare it to the pharmaceutical industry, the average is about 25. So Novo Nordisk looks cheap relative to its peers and its own historical average. But as with all investments, cheap does not always equal safe. A low PE ratio can be an opportunity to buy a stock at a cheap price. But the low PE ratio can also indicate some uncertainty and risk. There are some key concerns when it comes to Novo Nordisk. One, competitive pressure. Novo has been facing a surge of competition in its key markets, which are diabetes and obesity treatments. Two, growth deceleration. Novo recently lowered its 2025 growth outlook for sales and operating profit because of weaker than expected performance in certain markets. 3. Strategic and governance changes. There has been a significant board overhaul and strategic repositioning, and governance uncertainty often makes investors more cautious, which can depress the PE ratio. 4. Pipeline and innovation risk. In pharma, future earnings depend heavily on drug approvals, patents, expirations, and regulatory regional market dynamics, and any hiccups can meaningfully affect valuations. Because of these factors, the market may be pricing in risk of slower growth and lower margins, and hence the lower PE multiple. But the low PE might also signal an opportunity. There are arguments for considering Novo Nordisk as a potential value play, given its strong position in globally growing markets, obesity, diabetes, metabolic diseases. If Novo executes well, the low PE could mean an upside. And the cheap PE relative to peers suggests the stock might already reflect some of the risk, so there could be room for a positive surprise. Moving on to the price to book value. Price to book value is a valuation metric that compares a company's market price to its book value. We're trying to determine how cheap or expensive the book value of the company is. We want to know when we buy a stock how much book value we get for our money. The stock price now, when I'm recording this, is at 314 kroner, and the book value, we want the most recent book value from the quarterly earnings. QuickFS doesn't give us that, but Seeking Alpha does, so we're going back to Seeking Alpha. If we go to the balance sheet there and supplemental items, we can see what the latest book value is, and it's 38 kroner and 23 cents. So we take 314 and divide it by 38.23. That gives us a price to book value of 8.2. That means that for every $1 of book value in the company, you're paying $8.2. Generally, this is a very high price to book ratio. Normally, you would want to see a price to book value about 1.5 or less. If you remember when we looked at return on equity, it showed us that Novo Nordisk doesn't need that much equity to create income, and that's a good thing. Because that's the case, our price to book value becomes very high. In many other industries, this would be a very high price to pay, but in this context, it isn't necessarily a bad thing. So when is a high price to book value good? It's positive when a company doesn't need much physical capital equity to generate profits and earns very high returns on equity. That's what we have seen with Novo Nordisk, and that's normal for high quality asset light businesses. And a high price to book ratio is negative when the company has low profitability, low return on equity, or relies heavily on physical assets, plants, machines, etc. In those cases, a high price to book may mean the stock is overvalued relative to what its equity can realistically earn. And so in the case with Novo Nordisk, a high price to book is actually a good thing. At last, we are going to try to calculate the intrinsic value. In part 3, we'll calculate Novo Nordisk's intrinsic value using a discounted cash flow model.